Good morning, everybody. I'm Jeff Meyerson with SLS Group. We're a Salt Lake-based family office. We're a non-bank lender, direct investor. We're here at EnerCom to try and find more energy assets for our portfolios. Really excited today to introduce Phil Hodge and Pine Cliff Energy. What an amazing story of how a startup from a decade ago to a company that's producing over 21,000 BOE a day natural gas, based in Canada. Amazing story. No further ado, Phil.
Thank you very much. My apologies. There was definitely a mess up on the timing. But thank you very much for your attention today, for attending today, and learning a bit more about Pine Cliff. The good thing about it is we don't need a lot of time to go through the Pine Cliff story. It's a very simple story, and I like it that way. I would even go as far as to say it's a bit of a boring story, but it's been a fantastic story for cash flow. And I think the whole model has always been the same. We've always been, give you a little bit of background. I was the founder at Pine Cliff. I was the very first employee. A gentleman by the name of George Fink, who some of you longtime investors may remember. George was my chairman for the last decade. He was also the CEO and chairman of a company called Bonterra. Bonterra was focused on low decline oil assets in Western Canada. And George paid $1.3 billion of dividends over a couple decades. Paid himself $130 million of dividends during that time. He approached me back in 2011 about starting the exact same model on natural gas in Western Canada. We both had a belief that natural gas was going to be a pretty good place to be in the decades to come. That's how we started Pine Cliff. So we started with 100 barrels a day. As has been mentioned, we're now up to 21,000. It's been almost all by acquisitions. There's a couple very unique things about Pine Cliff. We're debt-free. That makes us one of the few oil and gas producers in Western Canada that has no debt. We've got about $50 million in the bank as of last quarter. We're paying one of the highest dividend yields that exists on the Canadian markets, not just oil and gas, but we're over 9% dividend yield. The magic to what we've built is the exact same thing that George always focused on in Bonterra. It's low decline. Our whole purpose is to continue to look for more assets that are going to make the dividend even more sustainable. We have the lowest production decline of any public company in Canada, period. We're the only single digit. So we're about 7% decline rate, where the industry average is about 30%. You'll find companies that have a 40% decline rate. We have 7%. Because of that, we're able to put a lot of the money back into the shareholders' hands. We have one of the highest payout ratios of any public company, again, in the space, where we're giving the money back to shareholders. That's, to me, is pretty key. I'm a very large shareholder in Pine Cliff. I've never sold a share. George Fink has never sold a share. AIMCO, some of you may be aware of the Alberta Investment Management Company. They're one of the largest pension funds in all of Western Canada. They're our biggest shareholder. This story resonates very well with high net worth retail and family offices, because it's a very simple story. It's very financial. It's not a geology story. We have some great well results. You'll find them on slide 32 of our deck. That's not why you're probably investing in Pine Cliff. It's the financials, it's the ability to generate free cash flow and give it back. And I really stress the word free on that. I'm a big believer in not talking about cash flow, because I think if you're generating $100 million of cash flow, but if it costs you $100 million to make that every year, you're really not generating, in my mind, any cash flow that you can give back to shareholders. We're all about free cash flow. We're very fortunate, because of the low decline, that we just do not have to spend a lot of money on drilling. And that allows us, we went from $50 million of debt at the beginning of 2022 to $50 million in the bank within 12 months. That's a pretty big transition. I mean, this was our cash flow for the previous 10 years. I can tell you, in 2021, it was a happy time at Pine Cliff. We did $59 million of cash flow in 1 year. Best year ever. In the second quarter of 2022, we did $55 million of cash flow in 1 quarter. Last year was a phenomenal year for cash flow. We put our dividend in place. We raised it twice. I can tell you, my wife has never been more happy with me than when we raised the dividend again. But what this year is a little bit different. This year is not going to be as good as last year. Gas prices have come down. Oil's still very strong. Now, we're about 85% gas weighted, but that 15% of our production makes up, at times, close to 35% of our cash flow. So the liquids in oil is still a very important piece. What last year was not good for was doing acquisitions, which is what we've done. We've done 11 deals over the last 12 years. That's grown us. We're one of the fastest from a production per share. And again, this you can tell who is it when you've got a shareholder behind here. Anytime they're talking about per share, that's all we look at. We are all about cash flow per share, reserves per share, production per share, and most importantly, free cash flow per share. This year is going to be a decent year. It's probably going to be our second best year ever, but it's not going to be as good as last year. However, I think it's going to be a good year for acquisitions, and that's what we've built ourselves around. And so that's what we are very focused on. We've never stopped looking at assets. The problem in 2022 was that the expectations from vendors went way up because cash flow was way up. So everybody wanted the same multiples, but they were building it off of the spot price at the time. Gas prices have now come down in Western Canada. We're a little under $3 AECO, Canadian priced right now. I'm a big believer, and I won't belabor the point too much, but I'm a big believer in where natural gas is going to be in the next few years, and we'll touch on that a little bit. This is the sustainability. The number one question I get is, how sustainable is your dividend? Again, it's true, it's mostly coming from my wife, but other people are interested in it. It's about $3 AECO and about $75 oil. That's sustainable for our dividend. We are paying $46 million a year in our dividend payments. We have over $50 million in the bank. Now, I've always told shareholders that if we needed to, we'll dip into the bank to keep the dividend going. That, to me, is very different than using debt to keep your dividend going. The cash flow is shareholder money. That we've actually thought about doing a special dividend last year and giving a big chunk of the shareholders back. But you could see what was going to happen on the A&D front. You knew that the acquisitions were going to be available to us. We knew that there was going to be some opportunities. I wanted to keep the powder dry. We could do a $50 million acquisition today and not use any debt or any shares. In our world, for a company of our size, that's impressive. So we're very comfortable with where the dividend's at. The one thing I would mention about Capex, and this is a bit of a something that always bugs me, is that a lot of companies, when they talk about Capex, they only talk about their growth and what they're spending on drilling. To me, I want to know if I'm really looking at free cash flow, I want to know every single penny you spend anywhere in your business. G&A, on what you spend on your power bills, what you spend on abandonment reclamation, everything. Capex in our world includes maintenance capital, it includes abandonment reclamation, and includes growth drilling capital. That's all built into the Capex. So when you're looking at our free cash flow, you're looking at our true free cash flow. This is an interesting one. This is all the natural gas producers in Western Canada. I don't know how many of you are familiar with all of them. Tourmaline on the far left, excellent company. Very well run company. In the last 3 years, they've drilled 800 wells. Each of us are about 85% gas weighted. In the last 3 years, we've drilled 10 wells. Both natural gas companies, both got the same rough exposure to natural gas prices, but just a very different business model. Again, it's not as exciting. You're not going to hear me talk about the Montney or the Clearwater or the Duvernay, which are all very exciting plays. Every company that's in those areas should be talking about those things. Ours is all about just operating what we operate, continuing to drive down the costs. We run very lean. Please come visit me in Calgary. You'll see that every one of all our desks are secondhand. We run 35 people in head office, and we're running a 21,000 BOE a day company. I've got about 100 people in the field. That's where the real work happens, and that's where we keep our production going. This is the decline rate. These are all the companies, public companies, oil and gas in all of Canada. You'll see where we are at a 7% decline rate. The industry average is around 28, 29%. Very different business model. This just talks about our free funds flow percentage, talks about our Capex being why it's so low, and again, it's because we just don't do a whole bunch of drilling. Again, this is one that people don't focus on too much, is the fact that we have been one of the biggest growth companies in Western Canada, even though we're not thought of really as a growth company because we're not out drilling. But we've done acquisitions. We're not scared to do acquisitions, but we haven't done one now in close to 2 years because the markets, in my mind, it was just too expensive. We are not getting bigger just to get bigger. That's not the goal. It has to make sense on a per share basis. Now, I do believe that we're going to see some opportunities this fall and in this winter that hopefully we'll be able to capitalize on. We're always in the process. We're notoriously cheap. That's just the way we run the business. And I think anytime you get the insider ownership as high as it is in our business, George Fink and I together own about 10% of the company. And like I say, Aimco's owns over 10% of the company. And then we got one other individual who owns just under 10% of the company. So, I'm always impressed that we still, our liquidity is about 1 million shares a day, which for a company our size is pretty good given that 30% of our stock, no one's selling. Those are the top 4 shareholders own over 30% of the stock. So I apologize if I'm a little redundant on some of this. Many of you are already well aware of what's going on in the natural gas front. It is a very exciting time for someone who's been around the industry for as long as I have. We've been talking about LNG in Canada for a very, very long time. And now you can actually see it over the horizon. It is quite exciting that where the LNG Canada is supposed to come on in 2025. But where the story gets really interesting is not just LNG Canada, it's what's happening with LNG in North America. And again, there's a couple of really quick stats that I'd throw out at you. In 2016, natural gas is now the single biggest source of energy in the United States. That was a huge shift away from move from coal. Alberta, the province of Alberta, did the exact same thing. Our very last coal facility shuts down in 2023. So natural gas is now a very big part of our energy grid. What's interesting is that, and it's extremely impressive, and I gotta say as a Canadian, I'm very envious as I watched what US did in the Gulf of Mexico. To go from 0 LNG exports in 2016 to become the world's largest LNG exporter as quickly as they did was extremely impressive. What's even more impressive is what they're gonna do. If you look in that bottom right-hand corner, and I've got these little 2-page handouts here I'd love for you guys to pick up. Right today, 14 BCF a day is what the United States exports in LNG. In the next 3 years, we're going to go to 28 BCF a day of LNG exports out of North America. Some of that's going to be Canada. Our LNG Canada project's about 2 BCF a day. Just to give everybody a context, if you're not, if you're not quite the natural gas geek that I am, 100 BCF a day is what production is in the United States right now. So you've got 14% of all your production is exported currently. That number is going to double in North America. So the question is, can supply keep up with that? Supply has been very, very good at keeping up, but with this much new demand coming on all at once, my thesis is that it's going to have a pretty positive impact on natural gas prices. We've seen how tight the natural gas market can be. We had $10 gas 12 months ago here in the United States. Because of a lot of different impacts going on, geopolitical with the Russian invasion, et cetera. That was before the Freeport LNG facility went off. The point being is that it can move very, very quickly. And I'm not sure everybody fully appreciates what's coming. This LNG is going to be huge. Mexico is going to be an LNG exporter. They don't even have the natural gas. They're going to use US gas and Canadian gas, and they're going to liquefy it off the West Coast. The reason for that is because the West Coast is an excellent place to send LNG from if you're focusing on the Asian markets. It is a much, much more economical, less emissions, because you're sending it off the West Coast, and you can see that it's 10 days to send it from the West Coast of North America as opposed to 24 days of shipping out of the Gulf of Mexico. So it's very interesting because it's unlikely that the US is going to have any new LNG facilities on the West Coast, because that would mean California or Oregon approving projects. But BC is going to have new LNG. And we're quite happy with the fact that LNG Canada is going to start, but LNG Canada is just the first phase. We're highly anticipating that they'll announce the second phase, which will take it to 4 BCF a day. To give you context, Canada only makes 17 BCF a day of gas. So we're going to go from exporting 0 gas other than to the US, and I don't want to diminish that because half of the gas produced in Canada today gets pipelined to the US, about 7.5 BCF a day. But starting in 2025, we're going to see we're going to have the first LNG project that's 2 BCF a day. The pipeline that's been built there, that Coastal GasLink, is built for 5 BCF a day. So they don't need to build a new pipeline. The pipeline's already going to be in place. All they got to do is add compression, and they'll be able to go to 4 BCF a day of LNG. That's going to be over 20% of all of the gas produced in Canada is now going to be exported out of the West Coast. That's going to have a positive impact on natural gas prices, which brings us back to our business model. That's why I'll be continuing to look to add more assets to what we've already built. The Western Canada gas continues to be extremely supportive. Here's a little trivia for you, the biggest user of natural gas in all of Canada is the oil sands. So oil sands uses about 3 BCF a day every single day, and they use it to create steam that they send down into the ground to allow the bitumen to flow. So we have the biggest user of natural gas anywhere in North America right in our backyard in Alberta. The coal to gas shift has happened in Alberta, so we're also a big natural gas producer. This graph on the right I find kind of interesting. I don't think people realize that natural gas storage hasn't grown at all through this whole huge, going back over the last 10 years, look how much we've seen in the supply and demand of natural gas grow. So we're up to, like I say, in the United States, the 100 BCF a day of supply and demands in that same, but storage is the same. But the analogy I make is that the engine has gotten a lot bigger, but the gas tank hasn't gotten any bigger. So anytime you need more natural gas, when you hit the gas pedal, you're going to pull down on your gas storage a lot quicker because it just isn't as big, and you have much bigger engine. Which is why the markets, you're seeing this volatility. You're seeing how quickly gas prices can move. We saw it in the first quarter of this year. 2 things happened that drove gas prices from $10 down to $2. One, we had one of the warmest winters in the East Coast in the last 100 years. So the amount of demand dropped for natural gas. The second thing is the Freeport LNG facility had its fires, and so it was offline. That was about 2 BCF a day. So those 2 things conspired to drive prices down. The point I would take out of that, though, is that that's how tight the markets are, and it can go the other way. We just saw how fast gas prices moved up when Australia announced that they may have some LNG strikes in Australia, and therefore LNG is not going to be able to move to Europe. All of a sudden, LNG prices spiked from a global basis because there's a shortage. And that's, I think, that bottom right-hand graph, that the white wedge is an LNG shortage that BP and Shell and others are predicting. All this LNG projects that I mentioned that are coming online, that's all represented by that yellow wedge in the bottom right. So that's already built in. But the prediction is by 2027, the world's going to need more LNG. I think the bottom left-hand, again, I recognize my audience. I suspect you already know a lot of these numbers. But 20 years ago, 80% of all the world's energy came from hydrocarbons. Today, 80% of all the world's energy comes from hydrocarbons. Everyone loves to talk about, for good reasons, to talk about the exponential growth in renewables. It has been exponential. It's still a very small piece of the pie. Natural gas, every single jurisdiction that uses natural gas, the demand continues to rise because it's seen as an environmentally clean solution to coal. And coal is still keeping up. We had record number of coal production and supply in the last couple of years. A big reason for last year was because of the Nord Stream explosions for Europe. So European use of coal went up. But eventually, coal has peaked. Hopefully, it's from a climate standpoint, it's going to continue to decline, but it's going to be resilient. Oil just announced all-time record, 103 million barrels a day of oil usage in the global. It's not going away anytime soon. The red, you can see, and the natural gas continues to rise globally. And that's kind of what we've built. That's what we've built the whole model around. I really believe that being a natural gas producer in Western Canada finally is on the right area, the right side of the pipe. For the longest time, Western Canadian producers, we were, as we say, on the wrong end of the pipe. We have to send our gas all the way down south and to the east because that's where the natural gas primarily markets are. That changes in 18 months. In 18 months, we're going to be able to start sending gas to the West Coast. And the LNG exports are going to continue to grow off the West Coast. So it's going to be a good time to be a producer. As I tell my board of directors, I feel I've got like an 18-month window. If I can find some assets to add to the portfolio, we will. we're clearly set up for that. With the cash reserves that we put in place and with the balance sheet strength that we have, if I don't find something that's going to make our shares a lot more valuable, we won't do any deals. I'm happy to keep clipping coupons. But I think we will find some of those deals. And like I said, I can say that with some experience because we've done those deals. We're very familiar with the areas that we're in. We know exactly the types of assets that we want to add to this portfolio. You're not going to see us announce a big deal where we're going to enter into the Montney or Clearwater. We view that there's going to be assets that are available that will fit this business model very, very well. We continue to run a very lean company with the shareholder base, very high, like I say, retail ownership, not just myself and our officers and George, but also a lot, like I say, a lot of family offices, because it's a very easy model to understand. You won't have any trouble. You go through our deck, it's a very financial model, but it's a model that generates a lot of cash flow. And I think going forward is going to generate a lot more cash flow. So we've already put in place, I think, a very balance sheet that is going to be able to survive and be able to prosper in an environment coming up here. I would, I think, welcome any questions or comments. The one little plug I would put on is that I do a quarterly email, which has really gained in popularity. I think we're up to about 1,300 subscribers now. It's because I don't talk about Pinecliff. I talk about what's going on in the natural gas world. And so it comes out every quarter. You can either give me an email or your business card, or if you go to our website, you can sign up for the CEO's quarterly emails. I think we got a couple minutes for questions, if there is any. And if not, I'll be hanging around. Guess we covered it all.
We'll take you to a break.